There is a company that has returned around 3,900% since 1994. So around 4,000% return in almost 30 years. This has been fruit of great past growth, a solid balance sheet, safe dividend. There is a company that has returned around 4,000% in almost 30 years. If you would have invested at the start, your money would have timed itself by over 40 times in only 30 years. That is clear outperformance over the S&P 500, and the truth is that this company is still attractive and still has great future prospects, a solid balance sheet, and it's safe from an interest payout point of view. So we will be talking about Paychex today, a company which provides human capital management solutions. So it is a leading provider of human resources solutions such as payroll, benefits, and insurance to small-sized and medium-sized companies. The main product it offers, or the main service, is a cloud-based platform for HR and payroll needs, featuring streamlined workforce management, scalability, and a cost-effective model. The good part about this for the company is that it has a retention rate of around 83%, meaning that 83% of the clients that start the year with Paychex end the year with it, which is great because it provides extremely stable cash flows and income. So Paychex Flex is the software as a service platform, which streamlines the workforce management with customizable solutions and analytics. Their plan and their strategy for the future is to further invest in this platform and other mobility apps for efficiency, also growing their client base and engaging in strategic acquisitions to increase their competitive advantage over the rest of the market. So this is the financial analysis, and just look at how beautiful these ratios are. First of all, the company has a return on capital employed of almost 20%, which is amazing, especially for a company of this size, which has been operating for this long. It has an interest cover of 55 times, meaning that it would be able to pay 55 times its interest with the money it generates in 1 year. This is wonderful to see. It means that it is in no trouble with its liabilities. It then has a cash conversion of 84%, which is good. We want to see it higher, but this means that they have room for improvement in this area. And then just look at its margins. It has 71% operating margin and a 41% gross margin. If this doesn't indicate pricing power and competitive advantage, I don't know what does. So let's move on to the fundamental analysis. And for me, this gets a clear 10 out of 10, or in this case, we're using 8 metrics. We'll give it an 8 out of 8. It has an existing mode and a competitive advantage. This can be seen through its retention rate, through its size, through its products, and through its brand. It is very difficult for the clients that it currently has for them to move on to a different company. Why? Because they have been using this service for a long time, they know how to use it, and they trust Paychex to provide the excellent service that they have been providing. Second, it has strong pricing power, and we can see that in the margins. 41% is just incredible. It has, of course, organic revenue growth and organic free cash flow growth with an insane cash flow consistency, which also arises from the 83% retention rate, I think it was. A solid balance sheet, which with absolutely no liability risk, as we have seen with the 55 times dividend interest cover ratio. And the best part of this is that it has a big dividend and it also conducts share buyback programs. The long-term analysis. It has great growth potential since this company follows secular trends. Which secular trends? Well, there's a secular trend of focusing more on the well-being of your employees in terms of benefits, managing their pays or their wages, handling their insurance and all that, especially for small and medium-sized businesses. Paychex says, if I remember correctly, that there are 8 million small and mid-sized companies which would be in need of their services, so there is an addressable market for them and there is room for growth. The only issue here is that their growth has been decreasing a bit, so right now they have medium growth projections, but their margins are stable. They're not decreasing, which is always amazing to see and a clear indicator of competitive advantage, pricing power. Now, their valuation, they have traded fairly stable in terms of EPS for the past 3 years. It is a bit higher than at the start of 2020, but it is a bit lower than at the end of 2021. As you can see, right now it is trading at around 26-27 PE ratio, and it is not bad, as you can see with their price action. Of course, if we would have bought this in May 2023, it would have been amazing, but we're here right now. They have a free cash flow yield of 3.43%, which is 10% above the long-term inflation rate, which is good. It indicates that it is trading at an attractive price. For those of you who are new to the channel and don't know what this means, it is a metric used by Terry Smith, a legendary investor, who says that in order to identify if a stock is at an attractive PE valuation, apart from looking at the historic PE ratio, you should also evaluate the free cash flow yield, which basically consists of dividing the free cash flow generated by the company over their market cap. This tells you more or less how much you're paying to get $1 free cash flow yield, something like that. So we will be getting more than the long-term inflation rate, which is attractive according to his evaluation, his analysis, and his historic trading. Now, the risks and possible challenges for this company, the main ones are performance, but we will dive into each one separately. So for competitors, which means the worsening competitive landscape, I give them 40%, even though there are 5 bubbles colored. That was my mistake, so don't worry about that. I give them a 40%, and the main reason for this is that there are no competitors that look threatening to Paychex, especially with the fact that their retention rate is so high and has been so high for the past years. The reason why I gave them a 40% instead of 0 or a 10% is because the retention rate has decreased when analyzed and compared to the past years. However, this decrease has gone from around 87% to 83%. They say it's not worrying and that it's just because of the challenges that the economy is facing right now. So I wouldn't worry about that too much. Regulatory, again, I colored 3 bubbles and I said 20%. So let's just give it a 25%. I don't think this will be affected by regulatory changes. I think the regulation in the US will move towards protecting more and more the employees, making sure that they have more benefits, better insurance. So this would just be beneficial towards Paychex. Then performance, which is not meeting growth projections. I think this is the biggest challenge for Paychex, as they are now being criticized for not being able to grow as much as they used to grow. So this would be the only risk factor I would see from investing in Paychex. And then the market, as said, with the competitors and regulations, the only possible thing here is that their growth has been affected by the current market conditions, and if this goes on, it could hurt their earnings, but I don't see it as too threatening. I just wanted to leave it here to be a bit conservative for the analysis. Now, in terms of the investment conclusion, before we move on, I have to say that I'm not a financial advisor. This is not financial advice. These are just videos I create for myself to look at investments and force myself to analyze companies and do the due diligence. But let's move on. So they do have a moat, strong competitive advantage with a strong brand and high retention rate. They provide extremely consistent cash flows with high predictability and high resilience. And of course, they have a high return on capital employed, which is creating a lot of value for the average Paychex investor. So I believe this is a great company, a great investment with high returns. I am unsure if I will invest in it yet because I have to do a deeper dive on the growth projections for Paychex, but I believe it is a safe investment. Nevertheless, remember, not financial advice, do as you wish. So thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic.